Hey, what's up, my friend? So, in today's video, I'm going to reveal to you, right, the truth about Forex brokers, which nobody tells you. Okay? So, number one, not all Forex brokers are created equal. They have different business model, the way they charge, the way they earn, and this is something that you must know. So, generally, Forex brokers, they fall into one of two categories. Number one is what we call a non-dealing desk broker, an ECN, electronic communication network. And the other is what we call a dealing desk broker, otherwise known as a market maker. So let me explain in details, right, what this means. For a non-dealing desk broker, right, they claim that whenever you put in an order with them, right, they simply, what they do is they shift your order, they bring your order into the interbank market. What is the interbank market? The interbank market, right, is where the big players, the big fishes, the sharks, they trade with one another, right? These are usually, banks, hedge funds, mutual funds. This is where they come together in a private network, right, and trade the FX markets together. And because we, the trader, the small fries, the ikan kurau, the ikan bilis, right, the small little fishes, okay, we are nowhere as big as the big fishes. This is why, we need somewhat of an intermediary like a broker to help us facilitate our trade. And this, right, if you ask me, I say that it's a little bit fishy. I have my doubts on this, and I'll tell you more why later, right? The second type of broker is what we call a dealing desk broker. So a dealing desk broker, right, is where, you put on a trade, okay, with the broker, and the broker, right, is the one that makes the market. So your order don't reach the interbank market. The broker is the one that creates a market for you. So if you buy, the broker is the one that takes the opposite side of your position. The broker would sell. So this is how, you get liquidity, right, by having the broker to trade against you. So usually how they manage, right, this business model is that if you're a losing trader, they have your records, right? What they usually do is that they will take the opposite side of your trade. They will, what they call a counter traded by the broker. If you buy, they sell. If you sell, they buy. So they will just, trade against you. This is what they do for losing traders. For winning traders, right, what they do is that they will usually try to hedge that position. So if they know that this trader is consistently profitable, if he's buying, right, I don't want to be, selling against him because he's a profitable trader. What I'll do is I'll try to take that position and match it with another trader who is selling. So this way, right, the position is kind of neutralized. So there's like no risk to the broker. If they can't do it, right, then they will hedge the position, maybe through the interbank market, right, or with other liquidity providers. So this is what we mean by a dealing desk broker. Your order does not go to the interbank market, right? It usually does one of two things, right? Whether it's, traded against by the broker, or they will hedge it or match it with other traders. So now, how do you tell the difference? And oh, by the way, if you are watching this video for the first time, you're enjoying it, right? Hit the thumbs up button, right? This way, you'll always get update, right, whenever I publish a new video. If you don't enjoy this video, hit the thumbs up button anyway, so I have time to convince you that, hey, this is a good video, okay? So how do you tell the difference? Non-dealing desk broker, right, they charge a commission on every trade. So for example, you put on a trade, right, they say that every trade, right, you will get charged like $7, right? That's a commission, right? You'll notice that their spread is usually lower in the realms of, for example, euro dollar can be like 0.1, 0.2 pips. That's usually from a ECN or non-dealing desk broker. And they usually have minimum size, like, one micro lot or one mini lot or even one standard lot. On the other hand, right, dealing desk broker, otherwise known as a market maker, they usually have no commission. They just charge you the spread. And it does not mean that they are cheaper, because their spread, right, it's usually higher than an ECN broker. So for example, euro dollar buy from an ECN broker is about maybe, 0.2 pips, for example. A market maker, they will charge you about 1 or 1.2 pips. So you can see that the spread is higher. And for market maker, right, one thing you'll notice is that they have no minimum size. So you can even trade nano lots, like maybe, a micro lot is 1,000 units. Market maker might even let you trade half a micro lot, like, 500 units. 758 units, yes, they actually allow that. So when you are able to trade like, those weird fractional lot size numbers, you know that you're trading with a market maker. And to be honest, right, there's no right or wrong here. This is just their business model. It's not that, they're out trying to get you, right, or they're trying to, rip you off. No, it's just their business models, right? These two different business models. And as I was saying, right, I have my doubts over here. Okay, so my doubts is on the EC and the non-dealing desk broker, because if you recall, right, theoretically, a non-dealing desk broker, they are supposed to just take your order and link it with the interbank market. But here lies a question that I have that I've not, figured out yet, is that the average transaction size on the interbank market is about $5 million. So if you put that in lot size perspective, the minimum size that is being traded on the interbank market is about 50 lots one time, right? Because one lot is 100,000 units, about $100,000. You multiply by 50, it's about $5 million. So the average lot size on the interbank market is 50 lots. And if you trade with a broker who claims that they are ECN, they might let you trade one micro lot or even one mini lot. Then to me, that doesn't make sense, because if that one mini lot goes to the interbank market, who is the one on the opposite end of the trade, right? To be accepting that one mini lot? Because if I'm a bank, I'm managing, billions of dollars. One mini lot is $10,000. That comes in is like a small fish, right? It doesn't matter to me because the lot size is too insignificant, right, to be worth trading with. So this is my doubts, right? When I say that, when a broker claims to be an ECN, I have my doubts over here because, again, I don't see how that small order can reach the interbank market, right, and be accepted, right, by the liquidity providers, because it's usually too small, okay? And I have thought about it, and there are two possibilities. Number one is maybe the broker, they have special arrangement with the players in the interbank market, like say, okay, maybe, I am willing to accept like, one mini lot or, a 5 micro lots and stuff like that. That might be one possibility. The other possibility is that the broker pull all these orders together, right, and then send it to the interbank market. That is another possibility, right? But as mentioned, right, I have my doubts over here, right, that when the broker claims to be a real ECN, a true ECN, at the back of my mind, I'm like, I'm not quite sure, all right? So this is something that you must know, and I want to share with you as well. Okay, so the first thing is that not all Forex brokers, they are created equal. Number two, Forex brokers don't want you to blow up your account. So I know this sounds contradicting. It's an irony because you always heard on the internet, oh, the brokers, they are trying to rip you off. They're trying to, get you to blow up your account because, they trade against you. You blow up your account, the more money they make. But if you think about this, right, if you think about it, right, in the long term, right, for brokers who are looking to be in business for the next 10, 20 years, if you blow up your account fast, there's no way they can, so-called milk any more money from you. Let me give you an example, right? So this is a term, right, which I learned, right, from, people who runs business, right? There's a thing called lifetime value, a lifetime value of a customer. So let's say, for example, a trader, let's say trader A, right? He gets so-called ripped off by a broker, okay? And he puts in $500 in his trading account. Maybe the broker, goes against him, right? Hunts his stop loss, whatsoever, and he loses that $500. He blows up. So the broker, technically, he makes $500 off the trader who lose that trading account, right? Because if, let's say, they adopt a market maker model, they trade against you, the trader who loses $500, the broker would profit $500. On the other hand, right, let's say there is a legitimate broker who doesn't want you to blow up. Instead, right, what it does is that on average, every time you put on a trade, right, they earn a spread. Let's say the spread each time they earn is, let's say, I don't know, $5, right? Each time they earn the spread. Whenever you buy and sell, they earn $5. And let's say, you are a consistently profitable trader. You put on many trades over the years. Let's say you put on let's say 1,000 trades, 1,000 trades. So you can see that 1,000 trades. This looks like a number 8. No, let's make it 8 then, right? Let's say you put on 1,008 trades, okay, over the period of 2 years. So 1,008 trades, you multiply by 5 as the spread, right, which is what your broker would earn. You can see that their earnings, right, if my math serves me right, their broker would earn actually $5,040 over 2 years of trading. So can you see that if you blow up your trading account, if your broker so-called cause you to blow up your trading account, they pretty much make that $500 one time and that's it, right? And the trader, move on, go elsewhere and doesn't want to trade with their broker anymore. But if you trade long with the broker, right, every time you put on a trade, right, you trade long, you're consistently profitable, the broker can always get a small piece of the pie from you consistently every time over the years. You can see that the broker would make much more money in the long run. So this is what we call lifetime value, right? Every customer, there's a lifetime value to it. Okay? So in essence, right, the longer you trade, the more money your broker makes. And those brokers who treat this as a legitimate business, not those fly-by-night, no white label brokers, no, those legitimate brokers who are serious about this business, they want you to trade longer because they know that the longer you trade, the more they'll make. And the longer you trade, right, chances are the size of your account would increase as well. You add in more funds again, the more they make. So this is why brokers, they don't want you to blow up, right? Because once you blow up, you give up. That's it. They can't milk you anymore. Game over. Okay, so this is the truth, right? That most traders will never tell you. They always say brokers are bad, but really, brokers, they do want you to succeed as well. Especially those brokers who are looking at this from a big picture point of view, from the long run point of view. Okay. Next one, right? Brokers don't hunt your stop loss. Why is that? So as mentioned, right, the previous slide, brokers, they want you to succeed. So why would they want to hunt your stop loss, cause you to lose, and then they risk losing any future business with you? And the other reason is also because in these days and age, right, a trader can just pull out two charting platform, MT4 or whatsoever, and see the price feed on these two platforms. And if there's any discrepancy, if there's one broker who purposely hunt the stop loss, a trader can just screenshot it, share it on video. Record it on video, publish it on social media, and the broker's reputation is finished. It's tarnished. So we can see that from a risk-reward point of view, from a broker's risk-reward point of view, trying to, hunt a small retail trader's stop loss and at the risk of losing his reputation, losing the license, and losing everything, doesn't quite make sense. So this is why brokers, they don't usually hunt your stop loss. They don't usually do that. What happens instead is that you get stopped up is because your stop loss is at a level where the institution, the hedge fund, the smart money tries to gun that level. So I'll explain this in more detail. So let's say, for example, okay, let's say this is a chart. Okay, let's say the price is up and down like this. And it's hovering somewhere about here. So at this point, okay, right, this is, as you know, this is the area of resistance. Let's call it R. And this is support. At this point, right, the smart money, the institutions, they know that, let's say they want to sell. Right? They can't simply just sell at this price level. Why is that? That's because their transaction size is so huge. If they sell, if they short, it would lead to a strong decline in price. So they got to be tactical about where they sell and where they buy. So for in this case, right, if they want to sell, what they would do is that first they would push up the price higher, like this, right? Push up, tuk, 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 tuk. Why are they doing this? Well, if you think about this, right, this is an area of resistance. And traders who are short, where would they put their stop loss? They'll put their stop loss above resistance. So let's say it's about here, okay? And if you are short and you have your stop loss above resistance, what type of order is it? Well, it's a buy stop order, right? A buy stop, let's call it BS. This is not BS, right? This is a buy stop order. Okay, it's a buy stop order. So let's say, again, remember the smart money, the institution, they want to short. And they just can't short at any naked price because the market would move, right, due to their large size. But if they know that there is a cluster of buy stop orders above this size, now they can start to buy and push the price up higher. And as the price goes up higher, it would trigger this cluster of buy stop orders. So this is where they can actually put in their real transaction size to short the market. So if they short the market, what order is it? It's a short position, right? Can be a sell limit, a short position, whatever. They're looking to short. So when they short at this level, this area of resistance, and they trigger this buy stop orders, what happens is that the buy stop orders will be neutralized by the selling pressure from the smart money. So what happens is that the market price will not just collapse like this because there is buying pressure to support this selling pressure by the smart money. Okay, so this is what is going on, right? The institution, right, they just can't sell at any price. They have to be tactful about where they are selling. So they have to know, levels where there are order flow, where there's liquidity, right, to kind of, ease the pressure that they're putting on the market. So in this case, right, you can see that if your stop loss is above this highs, chances are you're going to get stopped out as the price hits higher and then reverse from here, right? This is where, again, smart money, they can short without putting too much pressure on the market because there is a buy stop order here, right, that will neutralize the effect. Okay, so this is what I mean by, institution and hedge funds. The other thing that I want to share with you is major news release, right? This is another event, right, that might cause you to get so-called, getting stopped out of your trades. So let me explain. During major news release, right, you would notice that the spread tends to widen. Why? Okay, so it's because before major news release, right, the big players in the market, they're pulling out their orders because there is uncertainty in the market. They do not know whether the news will be good news or bad news. So what they do is they pull out their orders in the market. And when you get orders being pulled out of the markets, there is a gap, a liquidity gap. If you look at the, if you have a chance to access the depth of market, right? They call it the order flow. You look at the depth of market, you notice that the ladder, it's empty because the orders are being pulled out. So when the orders are pulled out, when the depth of market is empty, what happens is that the spread widens, right? So the bid and offer, the price, right? There's a huge gap in between, and that's why the spread widens. So if the spread widens on the interbank market, the futures market, what is going to happen to the spread on your retail platform? Well, it's going to widen as well because the prices on your platform, right, pretty much tracks what's going on the interbank market. So your spread widens as well. It's not because your broker wants to purposely widen your spread. No, they're just protecting themselves, right, from arbitraging opportunities, right? So this is why your broker also widens the spread, and they usually widen a little bit more to have a little bit more protection. So if let's say the interbank market, the spread is 10 pips, your broker might widen it to 20 pips. And so this is why the spread widens. So when the spread widens, right, what happens is that all you need is just a little bit of order in the market, like a few lots to push the market, and you can swing wildly. So this is why during big news event like NFP, you see very big spikes like this, right? Like let's say let me just redo this. Let's say prior to NFP, the market goes normally up and down, but before it, right, it starts to quieten, right? Just before it enters the news release period. And when the news is released, it usually spikes up, spikes down, and then it goes back to normal. So why the market can spike up, spike down so aggressively just after the news release is because, again, right, you don't need much order to push the market up and down. I think this is not a very good example. Let me just redo this. Okay, let's say the market, before the news, it moves something like this, right? Normal price movement. Then when it comes close to the news time, it goes quiet, right? Then news release, it spikes up, spikes down like that, and goes back to how it's moving previously. So the reason why you get this huge spike up and down is because you don't need much order to move the market. As I've said, right, the lack of liquidity in the market, you put in one or two lots, right, the price is going to fly up and down just like that. So again, if your stop loss is just above this highs, below this lows, or beyond any common levels, right, chances are you're going to get stopped out. And it's not because your broker is hunting your stop loss, but it's just because of this natural law of the market structure itself, right? The way the market, the way the prices moves. Okay, so I hope this kind of makes sense to you. So let's do a quick recap, right? Number one, not all Forex brokers are created equal, right? Their business model is usually either the ECN or market maker. And I also shared with you that I have my doubts about, brokers who claims to be ECN, because I just don't see how, right, that a small order can, be linked or just be, routed to the interbank market where all the big players are trading, right? I shared two possibilities, but again, right, I could be wrong. So just something to share with you. And also Forex brokers, they want you to trade longer. The more you trade, the more they make, right? Every customer, there is a lifetime value to it, right? If you stay longer, they can always, sort of like, milk you, right, or earn the spread, right, consistently over the long run. And it's much more profitable than just you blowing up your trading account within a short period of time. And then finally, we talk about, brokers, they don't usually hunt your stop loss. Usually you get stopped out is because you put it at the obvious level, or it's because there's a major news release, right? And that's why you got stopped out. All right, so with that said, I hope you've enjoyed today's lesson, right? If you've enjoyed it, hit the thumbs up button and subscribe to my YouTube channel. The button is below. Click subscribe. And any feedback, comments, let me know below and I'll do my best to help. With that said, I wish you good luck and good trading. I'll talk to you soon.